Anthony Grasso here, bringing you financial news you can use. In this video, I'm going to do a stock analysis on SolarEdge Technologies. I will go over a summary of the company, its product offerings, recent news, financials, analyst projections, and give it my buy, hold, or sell recommendation. So let's get right into it. SolarEdge Technology offers an inverter solution for solar photovoltaic PV systems. The company's products include SolarEdge Power Optimizer, SolarEdge Inverter, StorEdge Solutions, and SolarEdge monitoring software. Its product roadmap consists of categories including power optimizers, inverters, monitoring services, energy storage, and smart energy management. The company's power optimizers provide module-level maximum power point tracking and real-time adjustments of current and voltage to the optimal working point of each individual PV module. The company's solution consists of direct current DC power optimizer, an inverter, and a cloud-based monitoring platform that operates as a single integrated system. To sum it all up, the solar panels on top of your roof need an inverter, and SolarEdge provides that with a lot of other technologies included with it. So let's look at some headline news for this company. And this has kind of been a doozy. SolarEdge partnered with Tesla back in 2015 to provide inverters for the Tesla solar installations. And the company introduced an inverter designed to integrate with Tesla's Powerwall back in 2016. Now, Tesla launched a competing solar inverter in its latest move towards greater vertical integration, and that news sent SolarEdge on a nosedive recently, and we'll get into that. Tesla describes its latest product from its energy division offering. They said Tesla solar inverter completes the Tesla home solar system, converting DC power from solar to AC power for home consumption. Tesla's renowned expertise in power electronics has been combined with robust safety features and a simple installation process to produce an outstanding solar inverter that is compatible with both solar roof and traditional solar panels. Once installed, homeowners use the Tesla app to manage their solar system and monitor energy consumption, resulting in a truly unique ecosystem experience. Now, I wasn't too surprised by Tesla, coming out with their own inverter. I don't know about you, but I definitely was not surprised with that. The new Tesla inverter is already being installed with new Tesla solar installations, according to new buyers. Now, SolarEdge will definitely lose some future revenues from this broken partnership, but it is unclear how long that may take for Tesla to completely make the switch, or whether it intends to possibly dual source inverters and keep SolarEdge in the mix. We don't really know that yet, so it's that's just the big headline news right now. It is important to note, though, that Tesla's market share of US solar installations has been steadily declining for years as the company focuses more heavily on its core automotive business. Now let's go ahead and look at the competition. So looking at the competition for SolarEdge, Enphase Energy is its direct competitor, with also occupies a similar place in the solar market, providing module-level power electronics, inverters, and monitoring devices for residential solar projects. Think of this company as fighting for the same piece of the solar pie. The more of the market the two of them control, the more they'll be competing against one another for growth in the same segment. In the end, one of them could be overvalued at some point if they have the same market share. Now, these two companies are fighting for the same customers. SolarEdge core products are power optimizers that are attached to solar panels and inverters that convert the DC power those panels produce into an AC power used in our homes and businesses. Enphase Energy makes microinverters that convert DC to AC conversion at the individual solar panel level. Any given solar installation will only need one of these companies' products, but not both of them. Thus, competition between them in the residential solar market is a zero-sum game. That hasn't limited either company's growth over the last decade, but it could in the coming years. According to GTM Research, the two companies accounted for 30% of the U.S. residential solar inverter market in 2013. By 2019, last year and a half, their joint share was up to 79.7%. Taking market share from other rivals allowed them both to grow, but there's not much left to take except from each other. To examine who has taken market share today, given that Enphase and SolarEdge are competing for sales, I will be looking at the respective growth rates that should tell us which one has taken market share from which. At least since the start of 2019, it's clear that Enphase has been growing more quickly. Another thing to keep in mind is that residential solar is not exactly a growth market today, at least not domestically. In the third quarter, 728 megawatts of residential solar were installed in the US, according to SEIA. That is comparable to just under 700 megawatts installed in first quarter of 2016. So just slightly more. Installations vary from quarter to quarter and year to year, but overall, there's only been a small amount of growth in the rate at which the residential solar is being installed. But now let's go look at some basic fundamentals. The current market capitalization is $14.45 billion with an earnings per share of $3.36 a share. The company has a projected earnings to increase to around $4.66 a share by the end of 2021. Revenue has been steadily increasing year over year, which is a good thing. Investors are betting that components such as inverters and related power electronic systems, which are less commoditized compared to solar panels, could offer thicker margins in the long run, and I do agree with that sentiment. So how are the ratios looking for this company, which is really important to look at as well? The return versus industry, it exceeded the US semiconductor industry, which returned 51.2% over the past year. This is positive. The return versus the market overall, it exceeded the US market, which returned 19.6% over the past year. Also very positive. But it is a poor value based on its PE ratio of 79.8 times compared to the US semiconductor industry average of 45.7 times. It is poor value based on its PEG ratio of 3.1 times. It's also overvalued based on its price to book ratio of 14 times compared to the US semiconductor industry average of only 4.4 times. So that's kind of important to note. On the positive side, though, earnings are expected to grow significantly over the next 3 years. Forecasted annual earnings growth is by 25.9%. Its projected 2020 revenue is around $1.45 billion, with earnings of around $154 billion. And get this, the future projections out to 2024 place revenue targets at $2.79 billion with earnings of $399 billion. So that's over double what it's currently doing. Targeted earnings per share estimates by 2024 have it between $5.40 a share to $9 a share, with an average of around 7 or so. Now, the return on equity is forecasted to be high in 3 years' time, 21.1%, and the industry average is around 11.3%. The growing profit margin, the current profit margins are 11.5%, and they are higher than the last year of 8.4%. The balance sheet is very strong. Its short-term assets of $1.7 billion exceed its short-term liabilities of $382 million, and its short-term assets of $1.7 billion exceed its long-term liabilities of $863 billion. So the debt coverage is well covered by operating cash flows of 48.3%. It is important to note that individual insiders have only sold shares in the past 3 months, though, cashing out on some of their profits. The ownership breakdown is around 89.6% institutions, 7.3% general public, and 3% insiders. Now, the Wall Street analyst projections on this one. So the Wall Street has this as a hold. 5 are a buy, 9 are a hold, and 3 are a sell. The analyst price targets are $435 at the high end, $281 at the mid-range, and $77 for the low. I think the stock is currently overvalued by about 45.9%, and I think the fair value of this company today is around $193 a share. And as you can see here, it just tanked to $282 from its all-time high over here recently of $365. So it definitely took a nosedive. Now, the fundamentals of the company are solid with this company going into the future. Now, we have to look at the human factor, and that basically is kicked in the past couple months and right now. So am I a buy, hold, or sell position at this exact moment in time? Now, I am a downside buy on this stock with a strategy to nibble this one to the bottom of the bad news and then buy around the price target. Let's try to target the price of $200 to $250 a share and hold for the long-term position over the next 3 to 5 years. This is a long hold. on this particular company. I love the company, and I think it will do great things in the future. Now, looking at the human factor, people are freaking out at the moment, hence why you're seeing the sell-off, thinking it is the end of the world, but it's not. Also, I think that if investors race to lock in profits, we'll see further declines. So we might see a breakout between 282 to around 220-ish. I really hope it gets down to the 200 mark, and that would be my target to, you know, have the buy position at a huge, like, just go all in at 200. Now, if the 2020 earnings report in February is positive, you might see a huge bump in the stock price. And yes, the Tesla news was a bad jab to the company, but I don't feel it was a knockout. But be warned, this stock is more volatile than 75% of US stocks over the past 3 months, typically moving around negative plus or minus 12% a week. The long-term forecast is great for this company, but it's about not buying an overvalued stock, and getting it on the downswing might be the place for you. Also consider diversifying your portfolio with Enphase Energy, which I showed you earlier in the presentation, which I might do a video specifically on that coming up. Also, if you're a day trader, this might be one for you based on extreme historical volatility swings, because you can definitely profit on those swings. So there you have it, folks. I'm a downside buy on this company for the long term. Definitely look for the volatility over the next coming couple weeks, and keep buying on that downside, and keep the position long term, 3 to 5 years. This would be a buy and hold for the long run. So I want to thank you for watching this video. If you like this video, smash that like button down below, and consider subscribing if you like to hear financial news that can benefit you. And I will be with you in the next stock update video. Ciao.